Welcome back to Smart Dollar Mindset, the channel dedicated to helping you achieve financial freedom through smart money habits and investing. If I could go back in time and start investing all over again, I'd do so many things differently. And that's exactly what I want to share with you today: the mistakes I made, the lessons I learned, and the exact steps I'd take if I were starting my investing journey from scratch. This isn't just about avoiding mistakes, it's about accelerating wealth, building confidence, and creating a financial strategy that works. So whether you're just getting started or you've been investing for years, this video will give you a clear roadmap to make smarter choices and build long-term wealth. Why this topic matters. Investing is one of the most powerful wealth-building tools available to anyone, but it's also one of the most misunderstood. Too many people avoid it out of fear, jump into it blindly, or wait too long to get started. If you start early, invest consistently, and avoid common traps, you can change your entire financial trajectory. If you start late, you have to play catch up and work harder. Knowing what I know now, there are clear things I would change. And my goal is to help you skip those mistakes so you can reach financial freedom faster. Step 1. Start earlier. Time is your biggest weapon. The first thing I would do differently is start earlier. Compounding is the most powerful force in investing, and the earlier you begin, the bigger the payoff. Example, if you invest $500 per month starting at age 20 and earn 8% annually, by 60 you'll have over $1.7 million. If you wait until 30 to start, you'll only have about $730,000. That's nearly $1 million difference, all because of time. When you're young, even small amounts matter. Waiting is the most expensive decision you can make. Step 2. Focus on consistency, not perfection. Early on, I was obsessed with picking the perfect stock or timing the market. But here's the truth: consistency beats perfection. If I started over, I'd automate my contributions, invest every month regardless of market conditions, and trust the process. Dollar cost averaging not only reduces risk but also builds the discipline needed for long-term success. Step 3. Master the basics before getting fancy. When I first started, I chased hot stocks, IPOs, and whatever the media was hyping. What I should have done was master the basics, learn how index funds work. Understand diversification. Know the difference between tax-advantaged accounts like a Roth IRA and taxable brokerage. The basics are boring, but they build wealth. I'd focus on those first and only explore advanced strategies later. Step 4. Build a strong financial foundation. First, I made the mistake of investing before I had a real emergency fund. One unexpected car repair forced me to sell stocks at the worst time. If I started again, I'd make sure to have 3 to 6 months of living expenses saved. No high-interest debt dragging me down. A clear budget that frees up cash flow for investing. Investing without a safety net is like building a house on sand. It looks fine until the storm hits. Step 5. Embrace index funds and ETFs. One of the smartest things I'd do differently is focus more heavily on low-cost index funds and ETFs from the start. Instead of trying to beat the market, I'd own the market. Historically, the S&P 500 has returned about 10% annually. Few individual investors, and even professional fund managers, beat that consistently. Example, $10,000 invested in an S&P 500 index fund in 1980 would be worth over $1.2 million today. That's the power of simple, diversified investing. Step 6. Stop trying to time the market. One of my biggest mistakes early on was trying to buy low and sell high. I thought I could outsmart the market. Spoiler alert, I couldn't. If I started over, I'd commit to a buy and hold strategy. The market always has ups and downs, but historically it has always gone up over the long term. Missing just the 10 best days in the stock market over a 20-year period can cut your returns in half. Time in the market beats timing the market every single time. Step 7. Learn about tax advantages early. When I started, I didn't pay attention to taxes. Big mistake. Taxes can eat a huge portion of your returns. If I could start over, I'd prioritize tax-advantaged accounts like Roth IRAs, 401ks with employer match, and HSAs. I'd also learn about capital gains tax rules sooner. Example, if you invest $5,000 per year in a Roth IRA from age 25 to 65, you'd have nearly $1.5 million tax-free at retirement. Tax-free growth is a superpower. Step 8. Diversify beyond just stocks. In the beginning, I put nearly everything into 1 or 2 stocks. That's dangerous. If I could start again, I'd diversify across US stocks, international stocks, bonds, real estate, rights or physical properties. Diversification doesn't eliminate risk, but it spreads it out. One bad investment won't wipe you out if you're diversified. Step 9. Invest in myself first. This might be the most important lesson of all. If I started again, I'd invest more heavily in myself, through education, skills, and personal growth. Why? Because your ability to earn is your biggest wealth building tool. Every raise, promotion, or side hustle fueled by your skills is more money to invest. Example, spending $2,000 on a course that helps you land a $10,000 salary increase is one of the best returns you'll ever get. Step 10. Think long term, ignore the noise. If I could redo my investing journey, I'd stop checking the market daily, stop panicking over headlines, and focus on the long-term plan. Wealth is built over decades, not days. The market will crash. It will recover. Staying calm is one of the most valuable skills an investor can have. What this all means: with this mindset, I would avoid the temptation to chase trends that come and go. Instead, I would put my faith in time-tested strategies that prioritize steady growth over sudden, fleeting gains. Gradually, I would build a portfolio rooted in solid companies and diverse assets, allowing compounding to work its magic. Each decision would stem from thoughtful analysis rather than impulsive reactions driven by the market's volatility. Investing with a clear plan would yield lasting results. Ultimately, successful investing isn't about taking risks blindly, it's about making informed choices and remaining steadfast through market fluctuations. By adhering to these principles, I would create a resilient financial future, one that not only withstands the tests of time but thrives. Final thoughts. If I had the chance to jump in, I would prioritize starting early, even if the amount seems small. I'd contribute consistently to my investments, recognizing that the journey to financial growth is a marathon, not a sprint. Each dollar invested would be a step toward my future freedom, building a foundation for long-term wealth. I'd also educate myself continuously, knowing that each lesson learned would sharpen my skills as an investor. Striving for progress rather than perfection would be my mantra, allowing me to embrace mistakes as part of the learning process. I would tap into the power of compounding interest, understanding that time is my greatest ally in this endeavor. I'd avoid the pitfalls of market timing, focusing instead on maintaining a steady course, while remaining adaptable to change. Above all, I'd cultivate discipline in my investment strategy, reminding myself that real growth comes from consistency, not from chasing fleeting trends or quick fixes. Each step would bring me closer to the financial security I desire. Investing, after all, is not just about numbers, it's about cultivating a mindset. A mindset that embraces the journey and acknowledges that true wealth builds gradually. As I reflect, I realize that my past choices shape my present, and today is the opportunity to steer toward a brighter financial future. If this video helped you think differently about investing, make sure to subscribe to Smart. Our mission is to help you achieve financial freedom through smart money habits and investing. Together, we're building a community of people who refuse to settle for financial stress and instead choose financial independence. Start now. Your future self will thank you.